Welcome to our latest analysis. Today, we're jumping right in to deconstruct the really complex and, frankly, contradictory signals we saw coming out of the Asian financial markets for Friday, April 10, 2026. It was a day of stark contrasts for sure, and we're going to break down exactly what happened and why.
Okay, so let's just look at this. The market was getting pulled in two completely different directions today. You had your traditional industries, the ones in the Dow Jones, taking a bit of a hit. But then, on the flip side, the tech-heavy NASDAQ, and especially the Philadelphia Semiconductor Index, they absolutely surged. And over in Korea, the KOSP also posted some really strong gains. So what in the world is driving this split?
The story of today's market is really a battle between two massive opposing forces. On one side, you've got this undeniable, brilliant light of the AI revolution that's just powering a full-on technological supercycle. But on the other, there's this persistent thick fog of geopolitical risk, and that's keeping everybody just a little bit on edge.
So, to make sense of all this, here's our plan. We'll start with today's signals, then we'll look at how the experts frame them. From there, we'll check out the future outlook, explore a few strategic frameworks, and then wrap it all up with the key takeaways.
Okay, first up, let's really get into the weeds and take a closer look at the raw numbers from today's session across Asia and, maybe more importantly, the global factors that are pulling the strings behind the scenes.
As you can see, the Korean and Chinese markets showed some pretty significant strength today. Korea's KOSPI jumped a solid 1.4%, and you saw solid gains in both China's SSE Composite and Hong Kong's Tech Index too. Now, this was all driven by a rebound in manufacturing signals and just really strong tech performance, which was powerful enough to push through even with the Korean won weakening against the dollar. So the crucial thing to grasp is this powerful mix of factors. You've got these incredible corporate earnings in the AI space. I mean, just look at TSMC's blockbuster quarter. Then you've got domestic policy changes, like the Lee Jae-myung administration's Value Up program in Korea. That's a huge deal aimed at tackling the Korea discount, and it's really firing up investor confidence. You add in some tentative signs of a manufacturing recovery in China, and, well, for now, these positive drivers are just plain outweighing all the anxiety over global politics.
Okay, but how can we really make sense of all these complex moving parts? Let's turn to how the experts see it and unpack this using two really powerful analytical frameworks that help clarify the bigger picture.
First up is a theory from the legendary investor George Soros called reflexivity. And the core idea is kind of mind-bending. In markets, our perceptions don't just reflect reality, they actually shape it. What we believe can literally become a self-fulfilling prophecy.
And you know what? We saw a perfect example of this in action today. The market started to believe that this fragile ceasefire between the U.S. and Iran would stabilize things and bring oil prices down. And that belief, all by itself, led to selling, which then actually caused oil prices to fall. It's a fantastic real-time illustration of how a narrative, true or not, can directly move markets.
Next, we're going to use Professor Damodaran's corporate life cycle framework. This is just incredibly useful for explaining that big split we saw earlier between the booming tech stocks and the struggling industrial ones.
And this slide, this really gets to the heart of that divide. On one side, you have a powerhouse like TSMC, a company that's clearly in its high growth stage. I mean, revenue is up a staggering 35%. Its value is all about its explosive future potential. But on the other side, you have a lot of the Dow Jones companies. They're in a mature, stable stage. Their value is tied to what they have right now, current assets, cash flow, and that makes them way more vulnerable to today's headwinds, like interest rates and energy costs.
So with that context, this big battle between AI optimism and geopolitical fear, explained through these frameworks, we can finally turn to what the data models are forecasting for the rest of the month.
This is it. This is the core question for any investor, isn't it? What happens now? Well, to get a data-driven answer, the report we're looking at ran over 10,000 simulations using a really sophisticated model called a Markov chain Monte Carlo. So let's take a look at the price targets it spit out.
So, the models are basically predicting this upward momentum will continue across both Asian and U.S. tech markets right through the end of April. The NASDAQ is projected to see a solid 4 to 6% gain, but the real standout here is Korea's KOSD, which is showing potential for a whopping 6 to 9% of growth.
So how might someone approach this kind of environment? We're going to outline 3 distinct quantitative strategies from the report. Now, just to be clear, we're presenting this as an educational framework to help you understand market dynamics, not as direct advice.
All right, the first strategy is a pure momentum play on that whole AI trend. It focuses on the top companies and uses some classic technical indicators. For instance, it might use a tool called the MACD to help spot when a trend is changing and find a good entry point. Then, it uses something like moving averages to manage risk and know when to lock in profits. The goal here is pretty simple. Ride that powerful, high-growth stage wave.
Now, the second strategy is all about playing defense. It fully acknowledges that this fragile ceasefire could easily fall apart. So, this hedging strategy prepares for that possibility by putting a portion of the portfolio into safe haven assets, like the U.S. dollar or gold. Think of it like building a shock absorber into your portfolio just in case of a sudden negative surprise. The final framework is a really interesting approach called pairs trading. Now, in simple terms, it's a bet on the relationship between two related things returning to normal. In this case, the model suggests the cost stack has been underperforming the cost B recently. So this strategy is designed to profit when that performance gap closes, no matter which direction the overall market is actually moving.
So, after pulling all of that apart, what are the most critical takeaways from our deep dive into the market on April 10th?
It really comes down to three crucial points. First, ground your decisions in what's real, in actual earnings, not just the hype. Second, really understand the deep, long-lasting impact of major policy shifts, like that Value Up program. And third, you have to accept that high volatility is just here to stay. The key is to learn how to use quantitative tools to see that volatility as an opportunity, not just a threat.
And we'll end on this final thought from the report. While that fog of geopolitics creates very real, short-term fear, the light of technological progress is laying the groundwork for some seriously powerful long-term growth. So the crucial question this leaves us with is, how do we best position ourselves for that future?